Welcome to Deterra Royalties. My name is Julian Andrews, Managing Director and CEO. Before I begin, I'd just like to draw your attention to slide 2 and just note that any references to dollars are to Australian dollars. Deterra Royalties is an Australian-based royalty company with exposure to iron ore through its core asset, a royalty over the BHP-operated Mining Area C in the Pilbara region of Western Australia. By way of a brief overview, we have a portfolio of 6 royalties, 3 of which are producing, with revenue almost entirely weighted to iron ore through the Mining Area C or MAC royalty. We've been trading on ASX for about a year, following our demerger from Iluka Resources in late 2020, and have a current market capitalisation of approximately 2 billion Australian dollars, and at June 30 this year, we're net cash. Last financial period, we reported revenue of $145 million and recently announced revenue of $59.7 million for the September 21 quarter. The royalty investment model is well established and has some very successful examples. We're bringing that model at scale to ASX, but with some important differences. We offer investors quality. The MAC royalty is a Tier 1 asset. I'll talk more about the mine shortly, but in summary, it is a long life and low cost and forms a key part of BHP's globally significant Pilbara iron ore operations. We provide the ability to support strong earnings. Last year, we achieved underlying EBITDA margins of 96% and access to those earnings through a dividend policy of targeting paying out 100% of net profit after tax, fully franked. Clearly, dividend policy is always subject to board discretion, but we are building a track record in this regard, having declared fully franked dividends equal to net profit for the FY 2021 period. We have organic volume growth. Mining Area C has just completed a major expansion, with the South Flank mine beginning production in May of this year. BHP has stated that it expects this expansion to increase the production capacity of Mining Area C by 80 million wet tonnes a year, following ramp up over the next 3 years, more than doubling current production levels. We're also focused on adding assets to our portfolio in a patient and disciplined way, either through acquisition or investing in new royalty arrangements. And on the ESG front, we recognise the importance of sustainability to both our business and investors, and we have recently published our ESG framework, which includes a target to be net zero operational emissions by the end of the 2022 financial year. Our model is built on providing a qualitatively different exposure to the resources sector than can be obtained through investing in operating miners. A key attraction of this model is that revenue-based royalties can provide investors with exposure to commodity price and production volumes, that is a mine's top line, exploration and production expansion upside, with no operational involvement or capital commitment, which substantially limits exposure to capital expenditure and operating margins. I touched briefly earlier on the company's revenues, and the broader financial results for the FY21 period are set out on this slide. Although it is a very simple business, these results are complicated somewhat given the demerger partway through the period. But what is very clear is the strong EBITDA margins at 96% and the dividend payout of 100% post the demerger. Net profit for the period was $94 million, of which nearly $74 million was attributable to Deterra shareholders, shown here in orange. Turning now to slide 7, I mentioned earlier that we offer a somewhat different proposition to some of the other royalty companies, and one key distinction is in the commodities on which we focus. The very large majority of listed royalties and streaming companies, more than 90% on our estimates, are either exclusively or predominantly focused on gold and precious metals. We are not. Given our current asset base, we are focused on building a broader portfolio of royalties or streams in the base, bulk and battery metals sector. Although this sector is smaller in terms of total opportunity set, there are fewer investors chasing them, and it is a space that we think is less well served and one in which we can be more competitive. In terms of our current portfolio, the MAC royalty is a very high quality asset. It's low cost at the lower end of the second quartile, with a mine life of at least 25 years, and has substantial volume growth in the near term, as the South Flank mine ramps up to full capacity, which is expected to more than double capacity by mid-2024, following which it will form the world's largest iron ore hub. Just to remind you of the power of the royalty investment model, this growth will come at no capital cost and with no increase in operating costs to Deterra. Our interest in this mine comprises two elements: revenue royalty payments of 1.232% of Australian dollar denominated FOB revenue from product from the mine, and capacity payments equal to a one-off $1 million payment per 1 million tonne increase in annual production. The current operations at MAC produced 59 million dry metric tonnes in FY21, which resulted in $140 million of revenue. In this slide, we've included a sensitivity table that illustrates the asset's leverage to both the expected growth in volume and to realised iron ore pricing. We're also actively looking for opportunities to add to our portfolio in a value accretive way, either through creating new royalties or acquiring existing royalties. The MAC royalty and the organic growth it will provide is a very solid platform on which to base this growth strategy. In particular, it provides us the time and capacity to employ a disciplined and patient approach to evaluating opportunities. Our focus in this area remains on sectors we believe are less competitive. As I mentioned earlier, we see little value in focusing on commodities such as precious metals that are highly contested and where we're likely to be at a competitive disadvantage. Our activity to date has been focused on areas where we think we can bring value to transactions, which is more likely to be opportunities in the bulk, base and battery metals. Similarly, although we have a broad mandate, our preference is for opportunities in Australia and other well-developed mining jurisdictions, such as North and South America, those that are either in production or near production and of a scale that will be meaningful for the business. When it comes to funding growth opportunities, we will evaluate each funding decision on its merits, having regard to the specific investment opportunity and circumstances at the time. What we will not be doing is looking to use MAC cash flows to subsidise an investment that would not otherwise make sense. However, we are confident that the quality of our portfolio provides us with the balance sheet strength to fund growth as required. Although our own direct environmental and social impact is minimal given our small physical footprint, we are indirectly exposed to the environmental, social and governance risks of the assets in which we invest, and accordingly have developed a framework that reflects our particular ESG risk exposure. To date, our focus has been on embedding practices and policies to support our commitments, although I am pleased to note that we have taken some important early steps in this regard, committing to net zero direct emissions by the end of this financial year and applying to become a signatory to the United Nations Global Compact. These will be important in driving our future actions in this area, as we prioritise areas identified with the greatest materiality and further enhance our performance disclosures, as well as establish community engagement initiatives. To wrap up, we bring a qualitatively different way to invest in resources to the ASX. We have a world-class foundation asset, have demonstrated the ability of the model to generate very high margins. We have a dividend policy that targets paying out 100% of net profit, fully franked, and we have significant volume growth over the next 3 years. Thank you.